All right, today we're talking about something huge, the Great Wealth Transfer, an $84 trillion domino effect. And this isn't some far-off prediction. It's an economic shift that's happening right now. And trust me, the first domino has already tipped over. So what does happen when one single event sets off an $84 trillion chain reaction? I mean, think about that. A ripple effect that touches everything: financial markets, the house next door, even the digital world. Well, that's not a hypothetical. It's happening as we speak. And the event kicking this all off? It's called the Great Wealth Transfer. You can picture it like this slow-motion, multi-decade handover of, well, everything. All the assets built up by the baby boomers are now being passed down to younger generations, mostly Millennials and Gen X. But we are not just talking about inheriting grandma's house here. The scale of this is, honestly, it's hard to even wrap your head around. So just how big is hard to wrap your head around? How about $84.4 trillion? Yeah, you heard that right. According to research from Cerilli Associates, that's the amount of money set to change hands between now and 2045. That's the first domino, right there. So let's watch what happens when it starts to fall. Okay, so the first domino tips. And where does it land? Smack dab in the middle of the investment markets. And this is so crucial to understand. What we're seeing isn't just a transfer of money. Nope, it's a transfer of mindset. You've got two completely different playbooks here. On one side, you have the classic baby boomer portfolio, right? Heavily focused on stocks and bonds, the tried and true. But on the other side, you've got Millennials and Gen X. They're looking at things differently. They're diversifying into alternative assets, crypto, and maybe most importantly, they're putting their money into investments that actually align with their values. This isn't just a tiny course correction, folks. It's a seismic shift. And this quote from a Bank of America study just hits the nail on the head. It's no longer possible to achieve above-average returns solely on traditional stocks and bonds. I mean, that perfectly captures the skepticism of this new generation of investors. They're basically looking at the old playbook and saying, yeah, that's not going to cut it for us. And it's not just a feeling. The data is pretty wild. Check this out. A whopping 72% of younger investors agree with that quote. 72%. Now, compare that to investors over 44, it's way, way lower. You can literally see this massive confidence gap opening up between the generations. And a huge part of this new way of thinking is about values. Take ESG, that's environmental, social, and governance records. For 82% of younger investors, that's a key factor in their decision. 82%. For older investors, it's just 35%. What does that tell you? It tells you that the capital of the future isn't just chasing profits. It's chasing companies that are seen as doing some good in the world. Okay, so the markets are getting a serious shakeup, but that's just the first domino. What's the next one to topple over? Yep, real estate. And what's happening here is creating a brand new reality for the property market. It's leading to something analysts are calling the decoupling phenomenon. It sounds fancy, but it's pretty simple. While the rest of the property market is getting squeezed by high interest rates, the luxury sector is just breaking away. It's playing by its own rules. Why? Because these inheritors are loaded with cash. They don't need mortgages. So for them, high interest rates are kind of irrelevant. And when I say loaded with cash, I'm not kidding. Projections show that out of that massive $84 trillion, a full $25 trillion is expected to pour directly into real estate. That is an insane amount of money, and it's creating this powerful, almost insulated bubble at the high end of the market. You know, we're even seeing a kind of playbook emerge. Here's what happens. A millennial inheritor gets their capital. Step 1, they upgrade their main home, lock in their lifestyle. Step 2, with whatever's left over, they start looking overseas, buying up international properties in cool, culturally rich places to diversify their portfolio. All right, that brings us to our third domino, and this one is a uniquely 21st century problem. We've covered stocks, we've covered property, but what happens to assets that don't physically exist? The ones that are just lines of code on a computer? Yep, this is the digital domino. And calling this a ticking time bomb is honestly not an exaggeration. Just think about it for a second. Imagine all those private keys to crypto wallets. Some are on a hard drive in a dusty attic, some are on a slip of paper that got thrown out. When the owner passes away, that wealth can be gone. Not just transferred, not just lost temporarily, locked away forever. And we're not talking about pocket change here. The amount of wealth at risk is staggering. We're looking at as much as $6 trillion in digital assets, things like Bitcoin and Ethereum, that are part of this whole transfer. Without a solid plan in place, a huge chunk of that money could just, poof, vanish into the digital ether.
So, what are the core problems here? Well, it really boils down to three things. First, you've got lost private keys and seed phrases. If those are gone, they are gone, unrecoverable. Second, the law just hasn't caught up. There's no clear legal framework for this stuff. And third, the whole idea of self-custody, of you being your own bank, creates a massive single point of failure: the owner.
But look, whenever there's a problem this big, smart people start finding solutions. And that's what's happening now. We're seeing the rise of things like digital asset custodians. The easiest way to think of them is like super secure, institutional-grade digital vaults. They don't just provide safe storage, they operate within a legal framework. And that is the key part. It allows for a planned, orderly succession, and it gets rid of that scary single point of failure. Okay, so we've watched the dominoes fall one by one. They've crashed through the markets, they've reshaped real estate, and they've created this huge challenge in the digital world. Let's take a breath and step back for a second to look at the final picture this chain reaction is painting. So let's just recap the big impacts. In the markets, a massive shift towards alternative assets and ESG investing. In real estate, the luxury market is totally decoupling, just running on its own track, fueled by cash from inheritors. And in the digital world, a potential inheritance crisis is literally forcing us to invent brand new solutions from scratch. You know, when you boil it all down, this whole chain reaction comes back to one absolutely crucial point. We're not just watching money move from one bank account to another. This is something much, much bigger. It's a fundamental transfer of values, of priorities, of entire worldviews from one generation to the next. Because at the end of the day, the money is just a tool, right? The real story, the one that truly matters, is what this next generation is going to do with it. With their focus on things like sustainability, digital innovation, and this global mindset, will they reshape our world for the better? I guess you could say that's the $84 trillion question.